This episode is intended exclusively to provide information and education to help individuals better understand cycles. However, this information is not be construed as professional advice as to the buying and selling of securities or other investment instruments. In no event does the host express any opinion with respect to or make recommendations regarding the purchase or sale of any particular investment instrument. There is a very high degree of risk involved in trading securities. Buying and selling decisions are solely within the personal discretion of each individual.
From the mind of Lars von Thienen, the most advanced cycle analysis, hot off the press.
Yeah, welcome to another episode of Cycles TV. Hope you're still alive. Interesting markets out there. So thanks for even taking the time together with me having some cycle analysis work out today. So maybe it gives you a fresh mind in 30 minutes to get back to the markets. Today, I've chosen a topic which is very interesting at current times, however, not related to today's market action. So let's put aside some time to discuss something different than what's happening just today at this moment. So, everyone is currently thinking about, are we heading into a recession? Yes, no, maybe, yes, no, maybe not. Yes, no. So that's the big question out there. Recession ahead of us, yes, no. And there's one indicator which is often talked about in media, financial related communities. It's about the yield curve and the inversion on the yield curve, which we have for a very long time now. And this proved in the past as a very, very good indicator, leading indicator ahead of recessions kicking in, especially when these inverted yield curves uninverts. So that's also an important point to make. Not just the inverted yield curve is important, or to say it otherwise, it's not important if the yield curve inverts. The important point in time comes when it uninverts and gets back to zero. That's nothing new to you. I hope, at least. Otherwise, you will find a lot of information on that. I want to apply a little bit of cycle analysis to the yield curve and the inversion. So it's very experimental, and I even don't know if this will make any sense at the end of the session. But as we are dealing with cycles, time-based cycles, why not use our tools and analyze the yield curve and see if cycles can give us a clue or not? And if something, then let's discuss it. That's why we are the foundation for the study of cycles. So grab a beer, keep the markets aside, put your smartphone to the other way around. Don't observe what's happening in the next 20 minutes. So stay with me. Okay. Yield curve. So let's get into the studio. That's wrong screen. Give me a second. I need to sort that out. Moment. The yield curve. This is how the yield curve looks like. It is a delta, or the spread between in this case, the 10-year treasuries and the 1-year treasuries. So to build this curve, you use the 10-year treasury minus the 1-year treasury, and this gives then the delta, or the spread between these two US treasuries, and normally it should stay above zero, because that's the normal way. The long-term treasuries will pay you more than the short-term treasuries. That's the normal situation. So you would expect, if you subtract the 1-year from the 10-year, that you get to a positive spread. So that's why this curve in normal circumstances is always above 0. Then there are these times when we call this the yield curve inversion, when this spread gets below 0, because these are the points in time when we have some uncertain times ahead. So the long-term situation might not be clear, so that you get paid more on the short term than on the long term, which is not the normal condition we would expect in the economy and the financial situation. So this is when this curve drops below the 0 line. And you see here in gray, this is the times when officially a recession took place. These gray areas or periods of time are only known after the fact, so they are very late then added to that chart. But you see, from a leading point of these gray shaded recessions, when in the real world only are known very late and then are put later to this chart, the un-inverting yield curve, this is when the yield curve is going up again from below the 0 line. This acts as a leading signal when you could expect a recession to kick in. And this is why this curve is often regarded as some or one leading indicator, which is a precursor to possible recessions ahead. It's just one indicator, but it proved to be very reliable if you even go back to 1947. So every time, once this indicator has crossed below 0, has uninverted again, a recession kicked in. Will this happen again? Nobody knows, but this is why this is discussed often in the media. So that's our baseline. We use this data now for cycle analysis. So let's now switch to our cycle analyzer. And now you see the same curve here. I have just downloaded that data. It's available on the FRED, so the Federal Reserve of St. Louis, or you can create that data set on any charting platform and then upload it here to our cycle analyzer. So let's get to the screen. I will start with the long-term analysis going back here to 1962. So we will use the full data series, as we are currently not interested in predicting the curve. We are interested in, are there cycles in that curve? And that's the reason I use the full range of data first to check for the available cycles here. So using all the data, you see here the 0 line is marked with this small horizontal line, and then I've also marked the 0.5 level below the 0 line. So this is the area where we see these reversals here. But first, let's have a look at the cyclic situation here. So what is interesting, we clearly identify 2 key cycles. And by the way, we are analyzing weekly data here. So this is not daily, this is weekly data. So the cycle length is given and shown here in weeks. So if we have a look at the first prominent peak here, in that case, we are talking about a length of 285 weeks, which is a very long cycle running here, which has good statistical significance, which has a lot of strength, and then maybe a second one, from that peak here, even longer, around 330 weeks. I would not pay too much attention to the shorter cycles here, and the reason for that is the offset. The offset from the peak level here to the other amplitude peak level is quite large, and the shape of these 2 cycles is very prominent. And we are more interested not in short-term behaviors of that yield curve. We are interested in the longer-term behavior, and it's clearly that there are 2 cycles. These 2 cycles, if you don't know how to read a spectrum, So this is why I just try to explain. We always have some helping mechanisms in place, which we call the ranking score. Or we are currently teaching our cycle analysis engine how to read a spectrum. That's why we call it also AI engine. Yeah, but we as FSC board members teach and tell our computers and algorithm what is a good cycle. And then it shows just as a rank here. So maybe at some point in time we can get completely rid of the spectrum at all. But for now, we need both. So I would always encourage that you have a knowledge how to read a spectrum on your own. Second, then the table view and the ranking mechanism maybe might replace the manual reading on that at some point in time. But it's good to have both here. And you see both cycles would have been picked by the computer, so the 285 weeks and the 300 weeks. So we are on the same page here. Therefore, let's now start. That's the most important one. Let's start with the 285 week cycle here as an overlay. And then let's have a first study on that cycle on the overall data set. And as we clearly see, it seems to be that there is a good cyclic rhythm of the 280 weeks cycle in terms of time. You know that we are measuring the cycle in terms of time, not in regard of price swings. So even going back here, the whole period, you see here the top going down, going up. Here, the key low moving up into that area, going back into the top here, even, where are we? 1976. So we're talking about going back over 50 years now. Then it's clearly this low here, 1973. By the way, this is where I have been seeing the sun on this planet here for the first time. And then here, even that top going back into 1971. So I think that's quite a very, very good fit between a time cycle and the swings in the yield curve, isn't it? I mean, as said, we are not talking about the absolute movements. We are talking about picking the point in time when to expect a major reversal in the yield curve. So we have now a cycle. It seems to be it's valid in that data set. We can also visually just see and verify that cycle. So and now this is where we are in that cycle. I mean, the pure cycle by itself is not as interesting. As I said, here it's a little bit different today because we are not interested in forecasting the next top here. We are interested in, is there a kind of relation between the bottom here and uninverted or the uninversion of inverted yield curves, which could maybe help then to identify recession, yes or no. So that's the discussion we want to take in place. So it's not basically what we always do here, just a simple projection. We need to look now more closely when we have these cyclic bottoms here, and if there is an alignment even between when it goes below the zero line. So that's the second step. So now, as we have a cycle, we are interested in the points of time when the yield curve goes below zero, which is this small line. Maybe it's not visually as good, but I will help you to guide you through. And I've marked that area here. So maybe you should have a look at this line here. And there's the second line. And what I think is interesting is exactly what I call this area. So when the yield curve drops below zero, below that range, and then the uninversion takes place, and it will then come back into that area below zero and go up again. This is here the point when we would call the uninversion takes place, and only this is the point in time or the indicator when we could call it a signal. We are not interested if it goes down and down and down. That's fine, but that's not the trigger. The trigger comes when we come up again. So and we are exactly in that window now, and we are close to crossing the zero line again. So, but this is just the explanation. So let's now move back to exactly these points in time in the past. So we saw this. And in terms of timing, so we had this not only from the absolute value, also from the timing. The last time it was here in 2007. You see we broke exactly into this channel here and then came out of that channel. We had it here 2000, 2001. In alignment with the cycle. And I think that's now the point we need to closely observe. Not only the absolute value, so also when this happens in alignment with the cyclic timing. So I will come back to that a little bit later. So here we didn't come close to the zero. So this was not an inversion, although we had a cycle low here, but not the inversion. Here in 1989, this was another time. So this is a valid situation when we're close to that bottoming area and we touch here below the line. So this was an inversion at the point of the cyclic low here. And then we can even move larger into the past. So this was the year of 1989. So then the next situation occurred here at this point, 1978, 1980. So exactly at that point in time. And then we are at the end of the chart. So then we have 1974. There are other cyclic lows. There are also times when we are close to that line. But I would like now to pay our attention to the situations when all these, what I call conditions have been fulfilled. So we get below zero. We should touch this channel of 0 and minus 0.5. And it should be in the timing window of the cyclic bottom coming from the 285-week cycle. So 3 conditions. The yield curve has been inverted. It starts to uninvert, also going up back from in the channel of below the zero line, and timing-wise, in alignment with the bottom of the 285-week cycle. So I would call now this is the cycle in alignment with inverted and uninversion in the past. So now let's see when have these conditions been met. I walked you through a little bit through the chart, but this is the raw data. This is the basic timing. Now let's map this onto the price chart and see what it means on the price chart. So let's now switch to some charting and let me walk you through slowly. Because now I have mapped this chart also with some price information. I have now plotted that cycle first. It's just a zigzag cycle, but it's the same 285 weeks cycle. It's not just the kind of sinus or cosinus cycle. It's just plotted as a zigzag, but you see exactly the same timing cycle here, which has been rolled over from our cycle analysis platform here into TradingView. So it's a kind of special indicator and special feature we have embedded. So once you have found a cycle, you can kind of export it and then chart it in TradingView. And I have indicated to spot this a little bit better, the lines when we are below zero here with the blue lines and minus 0.5. So when we are on this, and these are exactly these situations I've colored it a little bit here, brushed in red. We are in that timing window. We uninvert, and we are in the timing window of the bottom of the 285-week cycle. So now I have marked all these instances with red coloring here. So these are exactly when all these conditions have been met. That's nothing new. We saw this already on the cycle analyzer. So let's now make this a little bit smaller. So this is our kind of indicator. And now let's bring in the S&P 500. And let's bring in the same cycle. I have just inverted the cycle here on the price. You see it's the same 280-week cycle. Yeah, it's just a top is here a bottom, because we want, if there is something in at these points here, when we have the alignment between, or let's start with the easy ones, the alignment of the cyclic low and the uninversion, and if it's true that a recession might kick in, this will then be aligned with tops in the US stock market. Because if a recession is ahead, we would expect the growth and the outlook of the companies to go lower, and therefore the stocks will decrease. So we will see moving down US indices at bottoms of that cycle. So I have just inverted the cycle here on the price chart. Yeah, and now let's review those situations we just identified here together. So we go back now in 1974, where we had the first instance where all these conditions have been met. So we need to zoom in a little bit better to see what happened at those points in times, and even to see the magnitude, what happened here. So, and as I said, we did a long-term analysis. Don't trust the phasing. The phasing is not what we are currently looking at. So the major alignment of top or bottom is not in specific exact, because we have a very long period analyzed. This would even be better when you just do it with a smaller amount. We're just interested in this idea now as a reference. Okay, so that said, so this was the condition, and here we had a huge drop in the US stock market from, I think, 50%. So we dropped from, or even here, 110 to 60. So this is a 50% drop in the US stock market at this point in time, right? So the next instance when this happened was here. So I mean, it's hard to identify, and I don't know if we can count this as a valid top, but at least we saw here also again a huge drop, which then occurred into that bottom here. So the top was not perfect, but at this point in time, and we had a long period when this happened, and just at the final uninversion here at this point, then we have gone back. What's the point here, from 140 down to that's maybe just 40%. So it's even not easy to time. But at least if you look at from that perspective, it was just a sideways overall situation. So this huge up move, and then very quickly coming down again. From that point in time here, it was just sideways. So you could have also stayed at the sidelines, not being long in the market here. And then once we arrive at that point here, re-enter for long. So then let's move on to the next situation here in 2000, 2001. I mean, I think we all remember what happened at that point in time. Right here you see it. So here again, we had the situation, the drop with the timing. So from here, so 2,500, 2,300, coming down to 700. So again, here we see a 50% drop in alignment with that signal. So here we have the next instance when this happened with that cycle and that condition. So here that was a little bit on. So this was the financial crash. which then has this at least the recession in the finance industry coming from, again, 1,600 down to 600, so even close to 60% drop. And we are now in the next window. Let's zoom in. So therefore, we are in that topping period, as shown. We still have this overshooting. I don't know if it's an overshooting. We anyhow will only know after the fact. But it's still the fifth time now. The fifth time since 1950. So for 75 years, in all instances, this indicator was on so far. So it was 100% on, not in the exact timing, but as a leading information that a recession and a drop, or even in best case, a sideways movement is to be expected. And we are in the early stage here. So, and we are close to un-inverting the yield curve. So, said that, I think there seems not only to be this absolute topic about the yield curve inversion, there are also two other conditions now which I try to explain. The un-inversion is important, and that it happens at the point of the time where our 285-week cycle is moving up again. So these two conditions I just added to the mix today. And yes, we are in that situation. So I would say this indicator is hot right now. Maybe calling for a recession ahead. Yes, it is. I mean, it's just one indicator out of many. And I'm not an economist or financial advisor. There are even other people out there which have much more knowledge on the economy and the conditions. I'm just reading data. So, but that's data, that's cycles. And no, to sum it up, I've put this also on a final summary chart here for you. Yeah, you can read it. Correct. Okay. Yeah. There's even more in. Let's go back to the analysis screen first. So this was just the 285-week cycle, right? And if you remember, I told in the beginning that there is a second cycle with 330 weeks, which, if you closely, I mean, you see this gets now almost a perfect alignment with everything what happens. So you could explain the complete behavior of the yield curve just with two cycles. I don't know what the root cause of these cycles is, but that's out of the scope. We are just analyzing if there is a cycle. And these two cycles count for, from a timing perspective, so change and trend of that data series have been on since all turns in that data set. So, and where are we? We are here. So in general, no change. We are now leaving the bottoming area, moving up. So it seems like from a cyclic perspective, we are on our way that now the un-inversion could took place, lifting us above the zero line again. So before that, so we still have been until end of last year, beginning of this year, we had been in the bottoming phase. So now we're coming out of the bottoming phase, allowing now for the un-inversion really to happen now, this year. Come on, get above the zero line. Get it. We have Olympic Games out there. Run, go. So let's see. But I wanted to bring in the second cycle. So now we have a composite here. And it's just a kind of visualization. But if we plot the composite here at the bottom, so it's the same cycle, it's just not shown as an overlay. I've just put it as an kind of indicator line above the chart. So you see some other interesting effects taking place. And you see that there was a time, 1986, close to 2000, when the composite out of these two cycles has gone flat. Yeah, right. So that period here, they have the cycles have cancelled out each other from their phasing, so there was flat. So no real impact on the movement of the yield curve. And when these cycles from their phasing come into alignment again, you see that this curve's, the amplitude gets interesting again, but this already only kicked in 2000. So there was a pause from 1985 until 2000 in the cyclic behavior. And putting that onto a chart, so this is what I did here. So this is the composite cycle at the bottom. Please follow me before you get irritated by the full chart here. So this is the composite, not only 285 weeks, also the 300 weeks in addition. And you see here now at the bottom, it's only the 280-week cycle, but I would skip that second cycle for a moment. I have marked here the points when these conditions have occurred. And you see that during this period, there was no real condition and the cycle has gone flat. So, and at these 2 points here, we have not really touched below this zero line. You could argue here, and I think we had this short drop. This was I don't know if it was COVID, but it caused a short recession here also at that point in time. But, and we have analyzed that now, at each other of these 4 points in time we analyzed, the stock market dropped always around 50%. And if this is the benchmark for today, or I mean, it's not today at the exact day, but we are in that timing window now, and the uninversion is close to happen. So the signal is on, the signal is hot, the cycles confirm that it should happen now. And you can also see it should not have happened before, because until early this year, the cycle was still moving down. So now, from a cyclic perspective, now we are in the timing window to uninvert this year. Yeah, I mean, you have heard about that, the ZAM rule. There are a lot of other recession indicators which come to getting alarming levels. I mean, no surprise what's happening in the stock markets due to these indicators. But let's see. So that's the point for today. Yeah, and I don't know if we can get a big clue out of that. But I mean, we are studying cycles here. So I think that was the point, just to show you, let's use different data sets, not only the raw data sets. That's maybe a takeaway also. Try to think about what spread could be interesting. Yeah. So if you compare 2 assets or take the difference of 2 assets and then analyze if there's a cycle in the spread of 2 data series. And it's not only the treasuries you could use, you could other 2 data series and see if they have a rhythmic cyclic behavior in terms of their spread. Similar what we do here, gold to XYZ ratio. It's also a spread. So analyzing the spread is a very interesting series to apply cyclic analysis, because spread often moves in cycles around a mean. So therefore cycles can help analyzing that kind of spread or cyclic behavior in spreads. And yes, it confirms recession from the un-inverting yield curve could be in the books today. That's it. Let's take a piece of salt on top of that. Yeah, it's just data. We're just reading data. The data, I don't care about news and economy. I'm just analyzing data. So you need to put in now your knowledge, your trade and risk management to decide what you get out of that. But at least for cycle analysis, very interesting. Yeah, if you want, put in your questions. I see some questions are already in here. And I spotted that question at the beginning. I mean, for sure, today was a big down day on Bitcoin. You know, I did a huge analysis on Bitcoin and crypto in our financial summit. So at least I want to spend 2 or 3 minutes to give you a quick update on that. And then I will come back to your questions. So take your time now, push in your questions, and I will show you the Bitcoin chart. So here we go. Let's clean up the chart. So if you're not aware what I'm completely showing here, I don't have the time to explain everything. Please move to our financial summit, review my Bitcoin analysis. This would explain it. But what we are discussing here is, I mean, this current drop here, yeah, right? I mean, come on, let's be careful here. It's in terms of the overall move, that's nothing really surprising. But you wanted to have an update, and I'm not really surprised because from a seasonality, we are exactly entering this kind of negative period now from a seasonal cycles point of view, and our time cycles suggested here. So that's the time cycle, and you might be aware that I'm monitoring the nominal 200-day cycle, which is the main aspect of that cycle, is heading into a low anyhow now for this week. So the current behavior is close to perfect in regards to dynamic time cycles, 200 days nominal cycle, and the seasonality which we are currently in. So no surprise. I mean, you will anyhow have big swings in that kind of asset, so you should not be surprised by that. The longer perspective is still valid. If you want to know the longer term perspective, please watch the video I did on that specific asset. So I hope that helps you in Civus. I think this was your question. In Civus. In Cisvus. In Cisvus. I hope that gave you a clue. All right. Yeah, that's these scary times. Where are we? Here are we. Everybody was aware of that we have this top right. Yeah, and hasta la vista, I think same what I just tried to explain. So don't be surprised in this seasonal period, which is anyhow negative, and we have a bottom dynamic time cycle in place. So that's what's going on. I would okay. Yeah, I mean, that's a question I can't answer, and I think cycles can not guide us that way. All we need to look when it comes to an end. The longer term time cycles I discussed here last week Monday, so key cycles to watch for the S&P 500, suggest that it will continue throughout next year. So at least it's I don't expect a short time from a dynamic time cycles perspective. It looks like that this will happen through 2025. But we even don't know if we get into a recession, so it still needs to be confirmed. And then, if I remembered correctly, the data series from Fred can be used directly in the cycle analyzer. Yes, that's correct. I just did it on my own building that data set, but we have the abbreviation FRD, and you can directly call any data series which the Fred API gives you. So you need to look up the correct ID in Fred API, and then you can use the same ID to directly load that data. We have a wrapper for the Fred data. Then that's right. So I'm not aware if, but I showed on the Fred, right? So it should be there. Yeah, you should be able to do that. Yeah, I think please allow that I will not go into the depth of individual notes I sent out in regards to the rating number or other topics. So I will keep it here as the basics cycle analysis session for today. And therefore, we're running now 40 minutes, so let's close the session for today. I think just to wrap it up, we took the current very interesting discussion on, is the yield curve, the inversion, interesting as a leading indicator for recession. We added especially that the un-inversion is important, and we added a time-based cycle, which since the beginning of this year suggests that we are now un-inverting time-wise and coming into that situation, which in the past 4 happenings led to a drop in the US stock markets of about 50%. Take it with a piece of salt. And otherwise, now you can go back to your smartphone and check what the market did in the past half hour. So that's, I think, what everyone will now do afterwards. If you just see this episode after the fact, give it a like, subscribe to be alerted, drop a note, thumbs up, whatever you want to like. This helps to grow the channel as we want to reach more and more people to grow the education on cycle analysis. Thanks for being with us today. See you soon. Bye.